one bucket of Roth IRA dollars subdivided into contributions, conversions, and investment earnings. Today, how to do Roth conversions the right way, the Roth 5-year rules that most people misunderstand, and backdoor Roth pro rata trap that catches a lot of people off guard. These 3 topics could save you or cost you a significant amount of money in retirement. Welcome back to the Financial Fast Lane. My name is Lane Martinson. For people with 401ks and IRAs, the number one expense in retirement will be taxes. This is because about 90% of all retirement savings are in tax-deferred retirement accounts, such as 401ks, 403bs, TSPs, and IRAs. There are 4.4 million words in the tax code. It is a massive and a complex system. And it's important to understand that there are hundreds of tax incentives in the tax code. Incentives are to encourage and reward specific behaviors. The problem is that your typical accountant, tax preparer, CPA, or other tax professional is almost always reactive rather than proactive. They are typically looking at the tax obligations for the past year rather than proactively planning for your multiple future years in retirement. When you have the bulk of your retirement savings in traditional 401k and IRA accounts, all of your contributions and all of the gains were tax deferred, which means that you have never paid taxes on any of it. All distributions will be taxed as ordinary income at whatever the tax rates happen to be in the years of distribution. The problem is when required minimum distributions kick in, starting at 73 under current law, the IRS is going to force you to take money out of those accounts whether you need it or not. And if those accounts have grown significantly, those RMDs could push you into much higher tax brackets than you are right now. There is a window of opportunity right now with historically low tax rates. If you do nothing, no conversions, you are deferring the problem. Those pre-tax accounts keep growing, but so does the government share. RMDs hit, and suddenly you are in a higher tax bracket than you ever expected, paying more in taxes than you ever did while working. That is what we call under-converting, and that is a mistake. But there is an equally dangerous mistake on the other end, over-converting. Some retirees hear about Roth conversions and they go all in. They convert large amounts, but without a solid plan. They end up paying taxes on money that could have been avoided with better planning. Overzealous conversions can also trigger additional taxes and Medicare surcharges. If you convert funds that could have been offset by deductions, you'd be paying taxes that were not necessary. Overconverting can be a very expensive mistake, and the sweet spot is where thoughtful, ongoing planning makes the difference. It's a balanced Roth conversion strategy. It includes tax bracket management and filling them up strategically. Convert enough to keep taxes low in the future without paying too much today. If done well, this approach can save you hundreds of thousands of dollars in lifetime taxes in a very meaningful way and increase the total wealth that you may pass on to your family. But it is not a set it and forget it strategy. It needs to be revisited every single year. Your income taxes change, tax laws change, your spending changes, the market moves. All of those things affect the optimal conversion amount for any given year. This is why personalized, ongoing retirement tax planning is not something you do once. It is something that you do continuously. Next is the 2 5-year clock rules. We get a lot of questions about the Roth 5-year clock rules and how they work. And it's no surprise because the tax laws are notoriously complex with multiple conditions and exceptions. And I'm going to explain in simple terms how the Roth IRA 5-year clocks work. Okay? The first thing to know is that there are 3 ways that money gets into a Roth IRA: from direct contributions, from conversions, and from investment earnings. The IRS knows which dollars within all of a person's Roth accounts came from contributions, which came from conversions, and which came from investment earnings. They keep track of that because Roth distributions follow strict ordering rules. When you take distributions from a Roth IRA, contributions always come out first. When they are depleted, converted dollars come out next, and when they are depleted, investment earnings come out last. These are the ordering rules, and it doesn't matter from which Roth IRA accounts you take the distributions from, because if you have more than one, The IRS sees all of your Roth IRA accounts as just one big bucket, regardless of how many separate Roth IRA accounts you may or may not have. One bucket of Roth IRA dollars subdivided into contributions, conversions, and investment earnings. So what about access to these dollars? A person can always withdraw Roth IRA funds, no questions asked. The issue is whether those dollars will be subject to a 10% early withdrawal penalty and/or if there will be any taxes on the earnings. So this is where the Roth 5-year clock rules come into play. There are actually two different Roth 5-year clock rules, which is why it's easy to get them confused. These two rules are used for different purposes. The first 5-year clock is used only for one purpose, and that is to determine whether the distribution of converted amounts are subject to that 10% early withdrawal penalty. The good news is that it's not an issue when the person receiving the distribution is age 59 and a half or older, since the penalty does not apply at all. And even if the person is under 59 and a half, the penalty still does not apply if the converted amount has been held for at least 5 years. So for example, let's say a 50-year-old completes a Roth conversion. They could access those converted funds penalty-free at age 55. This 5-year clock actually starts ticking on January 1st of the year of the conversion, so the actual holding period can be less than 5 years. To complicate things further, every conversion will have its own 5-year clock. But you don't need to worry about that if the Roth funds remain untouched until retirement or beyond age 59 and a half. The second 5-year clock has nothing to do with the 10% early withdrawal penalty. Instead, it determines whether the investment earnings within the Roth IRA will be tax-free or taxable when distributed. The second clock we call the forever clock. It starts ticking on January 1st of the year a person makes their first contribution or conversion to any Roth IRA. So for example, let's say a 62-year-old that has never had a Roth IRA does their first Roth conversion. They could access those converted funds penalty-free immediately. But any investment earnings on the converted funds would have to wait 5 years before the earnings would be tax-free. In this example, they would not want to withdraw their earnings until at least age 67. So getting the forever clock started is why it is so important for everyone to open up a Roth IRA as early as possible, even if funded with a small amount, just to get the clock ticking. So to rephrase, once a person is over 59 and a half and they have had any Roth IRA for 5 years, then they are home free. No clocks to ever worry about again. The only time a person over 59 and a half would have to worry about a 5-year clock is if and when they're in a situation where they have never had a Roth IRA until that first Roth conversion. So for our investment earnings to be tax-free, you have to have had a Roth IRA for 5 years, including people age 59 and a half. But once you have had any Roth IRA for 5 years and you're over 59 and a half, your earnings are tax-free and any existing 5-year clocks simply disappear. Now onto the backdoor Roth and the pro rata rule. Not everyone is eligible to contribute directly into a Roth IRA because of income limits. So if you take a look at my screen, if you are single and your income exceeds $153,000, you are phased out of your ability to make direct Roth IRA contributions. And you're completely phased out when you reach $168,000. And if you're married, filing jointly, then the phase-out limit starts at $242,000, and you are completely phased out at $252,000. If your current income level does not allow you to make Roth IRA contributions, you could do a backdoor Roth, which is the process of making an after-tax traditional IRA contribution and then converting that to Roth. It is easy to confuse Roth contributions and Roth conversions. The rules are very different for each. There are no income limits on Roth conversions like there are on Roth contributions, for example. Understanding the deductibility of traditional IRA contributions is important. If you're not careful, you could end up paying taxes twice on the same money, and nobody wants that. If your plan is to do a backdoor Roth, you may be thinking, well, I don't really care if I get a tax deduction because the Roth contribution is with after-tax money anyway. But there are some important things to understand with after-tax contributions to traditional IRAs, regardless of whether you complete a Roth conversion afterwards or not. So if this sounds confusing, I understand, but stick with me, and I'm going to give you an example scenario that I think will simplify things for you. Many times when discussing IRA contributions with new clients of mine, I've heard them say, well, Lane, I'm not eligible to contribute into an IRA. Then I would ask them, who told you that? And they would say either their accountant or their CPA. And then I would explain that they are in fact eligible to make a contribution, but it's a question of deductibility. The IRA deductibility rules are based on income level and whether you or your spouse, if you're married, have a company-sponsored retirement plan, such as a 401k. I'll break that down in another video. But if you have been told that you cannot make a direct Roth IRA contribution, you can still make an after-tax contribution to a traditional IRA and then convert that to Roth. The backdoor Roth is straightforward when your IRA has a zero balance prior to the after-tax contribution. You simply convert the full contribution afterwards to a Roth IRA, and you have successfully completed a backdoor Roth. But, and this is important, if your traditional IRA has an existing pre-tax balance, when you make an after-tax contribution, you will be adding after-tax dollars to your IRA, and you will have both pre-tax and post-tax dollars within the same IRA. Those after-tax dollars are now considered basis within your IRA, and they have to be tracked. This is done on Tax Form 8606, and it lets the IRS know that you have after-tax dollars in your IRA. Form 8606 will need to be filed every year that an after-tax contribution is made to a traditional IRA. In this situation, where you have a mix of after-tax and pre-tax money within the same IRA, the backdoor Roth gets a bit complicated because the pro rata rule comes into play. Now, I've been asked many times if a new IRA account could be set up for the purpose of doing backdoor Roth conversions with the idea of keeping after-tax and pre-tax money separated. Problem is, the IRS considers all of a person's IRAs as one big IRA. It does not matter where the IRAs are located or how many different accounts you may have. The IRS sees only one big IRA bucket. The pro rata rule says we need to consider all of your IRA accounts as one entire bucket and see what percentage is pre-tax and what percentage is after-tax. When a conversion is done, you cannot separate the after-tax from the pre-tax, which means part of the after-tax and part of the pre-tax will be included in the Roth conversion. Now, I recognize there's a lot of moving parts here, and when it comes to tax rules, they are anything but simple. I hope to make it easy for you to understand this complex concept. I'm going to give you an example scenario here. Hypothetically, assume your traditional IRA is 100% pre-tax dollars and it's worth $93,000. Also assume this is your only IRA, no others at any other bank. You make a non-deductible after-tax contribution of $7,000 in this example. Now your traditional IRA is worth $100,000. But the ratio between pre-tax and after-tax is 93% to 7%. Based on that 93-7 ratio, every conversion will be 93% taxable, regardless of how much you convert. So assume you convert $7,000. It will be 93% taxable, but you are not paying tax twice, although it may feel like it. Of the $7,000 conversion, you will be paying tax on $6,510. The remaining $490 is tax-free based on your 93-7 ratio. The conversion essentially grabs $6,510 from the pre-tax money in the traditional IRA that you never paid tax on, and then it grabs $490 of the after-tax portion. When those dollars hit the Roth IRA after conversion, they are then 100% after tax. But we only grabbed $490 of the after-tax dollars from the traditional IRA. The remaining $6,510 of your $7,000 after-tax dollar contribution remains behind in the traditional IRA. After the $7,000 conversion, your traditional IRA is again worth $93,000. But it now consists of $86,490 in pre-tax dollars and $6,510 in basis. Guess what the ratio is between those numbers? 93% to 7%. At that point, in addition to the $6,510 in basis in the traditional IRA, you would also have $7,000 in a Roth IRA. Every year that you make new after-tax contributions, it will change the amount of basis in the traditional IRA and change the ratio of any future Roth conversions. With future Roth conversions, you will carve out chunks of the pre-tax portion of your traditional IRA and pay tax on those never taxed dollars. You will also not pay tax on the smaller chunks of the after-tax dollars that gets converted. I know that this can seem complex because it is quite complex, but hopefully this was helpful. If you would like our help with proactive tax planning, you can contact us at martinsonwealth.com. And I look forward to seeing you in the next episode of the Financial Fast Lane.